Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is how commercial real estate lending may be affected by the U.S. Basel Endgame proposal. My name is Matt Bisanz, and I'm a bank regulatory partner in Mayor Brown's Washington, D.C. office. Joining me today are two real experts in CRE from our Charlotte office, Eric Reilly and Miller Smith. With that said, let's dive right in because I know that we've done a series of these on Basel Endgame. So to refresh for those of you who haven't listened to our earlier episodes, in July of this year, the U.S. banking regulators proposed extensive revisions to the capital requirements for larger banking organizations. These revisions will affect the 40 or so largest banks in the country who, while they are only 40 among 4,800 banks, constitute the vast majority of banking activities, both in the commercial real estate sector and in banking in general. The changes will affect all aspects of a bank's capital structure, including the way it recognizes unrealized losses on available for sale securities, the way it measures credit risk and holds capital against credit risk, which is also the risk of default or risk of failure to pay. It'll completely overhaul the approach to measuring and holding capital against market risk, which is the risk of changes in the prices of assets or in the market economy. Things like interest rate risk are built in to some extent there. And then it will create an entirely new framework for measuring and holding capital against operational risk, which, as I like to say, is the risk of something bad happening. There will be other changes in terms of long-term debt and GSIB surcharge and lots of stuff that probably is not of interest to the commercial real estate sector. And I've really gotten an education from Eric, Miller, and others because we've been working with some CRE clients on how they will respond to the proposal and the specific effects it has on the unique characteristics of CRE. So while it's not targeted at CRE, it's targeted at all parts of a bank, all lending exposures of a bank. It's going to affect residential mortgages, CRE, credit cards. It's going to affect letters of credit. It's going to affect trading of stocks and hedging of interest rate risk and other risks. It's going to affect things like how banks account for thefts and losses and fires, that it really is a wide-ranging impact. The effects it will have on CRE are almost collateral, that the regulators didn't set out to create problems for CRE, but in doing such a large 1,100-page proposal that affects so many parts of the capital calculation, it's kind of hard not to create some of these problems for CRE. And as speaking as a generalist regulatory lawyer, I won't pretend to know all of them, and that's why Eric and Miller are here. So maybe Eric, do you want to get us started?
Absolutely, Matt. Thank you. And as you noted, this is applicable to all asset classes, not just CRE. Many trade organizations are in the process of drafting comment letters with respect to these proposed rules. But from an overarching perspective for CRE and also the other asset classes, there's very little support in the proposed rule that the current capital rules are not sufficient to protect banks from stress, or why the proposed rule is an appropriate revision to the current rules and the current calculation methodology. There's also a lack of analysis of the quantitative impact of the proposed rule or the assessment of the cost versus the benefit of the changes that the proposed rule would bring forth. Some other consequences with respect to the proposed rule, and Miller will go into with some more granularity some of the more focused CRE specific effects. But from a general perspective, when you talk about CRE lenders, an argument can be made that these proposed rules and the increased capital costs for banks will cause riskier assets to be shifted to be financed by non-banks, which could cause negative results. Also, some commentators have mentioned and analyzed what the effect would be for U.S. banks versus non-U.S. banks and other non-bank entities such as insurance companies. With that, Miller Smith will go through a couple of the high-level CRE specific points.
Thanks, Eric. Hi, everybody. My name's Miller Smith, and I'm a partner in Mayor Brown's Banking and Finance Group in the Charlotte office. And as Eric mentioned, I'm going to talk today about three specific areas of concern for the CRE lending and CRE finance markets with respect to the proposed changes to the regulatory capital rules. First, as it relates to the securitization market in general, it is expected that the proposed rule would increase the capital requirements for most exposures to securitizations, and this includes CMBS and CRE CLOs. This is due to the fact that the proposed rule would establish a new securitization standard approach in place of the current supervisory formula approach and standardized supervisory formula that would include an increase of the supervisory calibration parameter known as the P factor, used to determine the risk weights for a securitization exposure from 0.5 to 1.0. The P factor is a regulator-selected variable, and it's intended to mitigate the risk that the general risk weights used with underlying exposures were set incorrectly. And it's worth noting that this would be in addition to the W factor, which is a variable in the securitization standard approach that effectively increases the risk weight for a securitization exposure if the underlying exposures begin to default or satisfy other adverse performance criteria. In addition, the proposed rule would require banks to look to the performance of the borrower with respect to credit obligations to any creditor when determining whether a non-retail exposure is a defaulted exposure. So this means that if a borrower has any credit obligation to any creditor that is 90 days or more past due or in non-accrual status, is the subject of a distressed restructuring or the subject of a negative adjustment by the creditor for credit-related reasons, then the bank would be required to treat all exposures that are credit obligations of that borrower as defaulted exposures. Under the current U.S. rules, a bank has to assign a risk weight of 150% to past due exposures on an exposure by exposure basis. And the international standards indicate that banks should assign a risk weight of 150% to all of the bank's exposures to a borrower if the borrower defaults on any exposure to the bank. So this means that the U.S. proposal is more restrictive by imposing this universal cross-default restriction on all commercial borrowers that is not present in the international standards. So one specific concern with this particular requirement is whether bank lenders would even be able to obtain the necessary information to assess whether their borrowers' obligations to other creditors are defaulted. There's really no market practice or obligation for creditors in this space to centrally report or publicize defaults by commercial customers, unlike in the consumer space where you have credit reporting agencies and just non-retail borrowers. Many of them are private companies that just do not publicly disclose financial statements, let alone report defaults. And furthermore, and probably of particular concern to participants in the commercial mortgage market, the proposal requests comment on whether the CRE-related provisions of the proposal should be revised to require a bank to consider both the obligor and the parent company or other entity that or individual that owns or controls the obligor when determining if the exposure is a defaulted real estate exposure. So because CRE is often held through SPEs or special purpose entities, the borrower itself may not have other creditors, which would make this requirement irrelevant. But if this is expanded to include the parent company or other owner controlling entity, the concerns I just mentioned would apply to CRE loans that are held through SPEs as well. And lastly, the proposed rule would change the capital treatment for unconditionally cancelable commitments and commitments that do not have an express contractual maximum amount that can be drawn. There's a credit conversion factor that applies a percentage to the notional amount of an exposure prior to applying the risk weight, as if the exposure were on the bank's balance sheet. And under the proposal for unconditionally cancelable commitments, the credit conversion factor would increase from 0% to 10%. And for commitments that do not have an express contractual maximum amount that can be drawn, banks would be required to impute an amount based on 10 times the historical line usage. We understand that market participants are concerned that this could have a negative impact on committed warehouse lending facilities for commercial mortgage loans. And that applying a punitive credit conversion factor to these deals could cause banks to cease offering this product. And because these facilities are an essential step in the securitization process for many CMBS and CRE CLO issuers, securitizations could become yet even more expensive to execute. And furthermore, on this point, CRE borrowers may carry relatively high balances on warehouse lines because of the large dollar value of the underlying properties and the large balances of the loans. But this doesn't necessarily correlate with with financial stress, because these facilities are intended to be used, and it's expected that the borrowers will use these lines to accumulate CRE exposures prior to executing a securitization. So we've also heard concerns that requiring banks to apply a multiplier that's designed for consumer credit card lines to these CRE facilities will cause banks to impose limits on CRE warehouse facilities, which could further slow real estate lending and require unnecessary renegotiation and re-underwritings. And with that, I'll turn it back to Matt.
Great. Thanks, Miller. Just a few comments on what you said, because I think some of them are really insightful for our listeners. That when you talk about the fact that the change to the credit conversion factor affects all types of lines, regardless of what market practice may be, credit underwriting, that you have a CRE warehouse that is highly utilized because it's accumulating loans, versus say a credit card where increases in utilization portend ill effects for a consumer. I think that's a big theme that we've seen in a number of places in the rules, that there really isn't consideration of the credit risk attributes of various asset classes. And one place that I think this comes up particularly with CRE is that there really isn't a consideration of the fact that you have a building there or a piece of property that's not going to go away. And so many of the proposals risk weights for CRE, as you were saying, not just in the undrawn lines facility, but also in the defaulted exposures risk weight and even the undefaulted exposures risk weights. They treat CRE almost the same as an unsecured loan to a corporate. There's some variation, but it's almost the same. And so while if an unsecured corporate defaults, you have to go sue them in court or put them in bankruptcy and then try to seize their assets and sell them off, and you're probably not going to get much if they don't have many assets. In CRE, you have an asset, usually in a bankruptcy remote SPV, so you're going to get the building. And so saying that those have the same credit risk profile, to me as an outsider, just seems kind of silly. And it appears in other places that the regulators also in the op risk cap requirements treat all revenues the same. So the revenue that a bank might get from renting foreclosed CRE for 2 to 5 years, even though it's a steady rental income once the bank rehabs the building, that's treated the same as highly volatile underwriting revenue. So again, that's something where the regulators aren't differentiating on a risk basis. But like you said, that it won't be the end of CRE lending. It'll just make it more expensive in certain ways. Um, and I think that's one thing for our non-bank listeners to remember, is that it's not as if a bank's going to say tomorrow, oh, we're not going to offer you this product. They might say, well, look, there's been changing regulation, and now we're increasing your facility by X or Y basis points, or we're changing the term of it, or the amount that we're willing to extend, or maybe we're putting a more explicit cap on how much you can draw, because we need to manage our undrawn limits more closely. So I think that that's something that people should be aware of while banks will obviously be looking closely at this and telling their business lines, you can or can't do this, or you must reprice in one way or another. Um, the CRE borrowers, the property developers, they'll only see this in a secondary manner, that they'll see it in revised term sheets. When times come for renegotiation or refinancing, they might say, wow, these terms are really different than what we received before. What changed? And the bank may say, well, it's the P factor doubled, or the bank may say, well, look, it's now another real estate exposure that gets a really high risk weight. Or the bank may say, look, it's just regulation. And knowing those kind of things is one reason why I think so many clients, both on the bank and non-bank sector, have been reaching out to people like you and Eric, because it is good to have that knowledge when you're going into a negotiation, that it's not just the commercial terms, but the regulatory pressures that led to those commercial terms. But with that, I think that's all we have time for today. Thank you, Eric, and thank you, Miller, for really bringing some great expertise in this unique niche of the market. I also want to thank our audience for listening. Without you, we wouldn't have a reason to do these podcasts. Listeners, if you do have any questions about today's podcast or anything related to the Global Financial Market series, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.